One of the most powerful software companies in the world just lost 11% of its value in a single trading day. Oracle, the database giant that powers thousands of major companies, tanked because investors learned something shocking. The company needs way more cash than anyone expected. This isn't some cash-strapped startup. This is a company that makes $10 billion every single year. Yet on Wednesday this week, Oracle announced they are raising $30 billion. That's roughly 3 years of profit needed right now for one massive bet. And here's what everyone's wondering. What exactly is Oracle so worried about that they need that much money all at once? The answer is artificial intelligence. Not just dabbling in AI, but the infrastructure, the data centers, the specialized computers you need to train and run modern AI systems. Every major tech company, Microsoft, Amazon, Google, Meta, they're all locked in an enormous spending war right now. They're building massive data centers, buying millions of specialized chips, upgrading network infrastructure. It costs more than most countries' entire budgets. Oracle looked at what everyone else is spending and realized they couldn't compete with what they had sitting around. So they're borrowing $30 billion to jump into this race. But here's the really important part. When a company admits they need that much cash, it signals something bigger about whether these companies actually understand how expensive artificial intelligence is becoming. To understand why Oracle's stock crash matters, you need to know what Oracle actually is and why people care so much about this one company. Think of Oracle like the backbone of the business world. For the past 4 decades, Oracle has been the company that manages databases for huge enterprises, basically the filing cabinets where the world's biggest companies store all their critical information. Banks use Oracle. Insurance companies use Oracle. Hospitals, airlines, government agencies, they all run their core operations on Oracle software. The company made itself indispensable by becoming the most reliable way for giant organizations to manage vast amounts of data. Because Oracle is so important to so many critical systems, its stock has historically been one of the most stable in tech. Investors trusted Oracle. The company was profitable year after year. It wasn't flashy like Apple or exciting like Tesla, but it was solid. It made money reliably. It had customers locked in. Switching away from Oracle software is extremely expensive and disruptive. So once companies committed to Oracle, they stayed. That stability meant Oracle's stock was seen as a safe bet. When a safe bet suddenly crashes 11% in one day, Wall Street pays very close attention, because it's not just about Oracle anymore. It's a signal about the entire tech industry and what companies are actually prepared for. Let's talk about what actually happened that spooked investors so badly. Oracle announced they're raising $30 billion in additional capital. To put that number in perspective, $30 billion is more than the total revenue of most countries. It's what some nations spend on their entire military budgets. For context, the entire video game industry generates about $50 billion a year. Oracle's capital raise is 60% of that entire industry's annual revenue. Now here's the key question every investor is asking. Why does Oracle suddenly need $30 billion? The official answer is infrastructure and partnerships. Oracle needs to build massive data centers filled with the specialized chips required to run artificial intelligence. They need computing power, and they need it now, because they are locked in a competition with companies that have already spent hundreds of billions on this exact same thing. Think of it like a poker game where everyone's been betting for 3 years, and Oracle just realized they don't have enough chips to stay at the table. They're not panicked exactly, but they are serious. The company is admitting they underestimated how much this artificial intelligence race would cost. They are saying, we need to double down right now or we fall further behind. And that message, that realization, that's what terrified the market. Oracle isn't just raising money to sit on it. They have specific plans for where this $30 billion is going. First, they're massively expanding their cloud infrastructure. Think of cloud infrastructure as renting out computing power over the internet. Companies don't want to build their own data centers anymore, so they rent computing resources from companies like Amazon, Microsoft, Google, and Oracle. Oracle's cloud service is smaller than its competitors, which means fewer customers, which means less money. They're trying to catch up. Second, Oracle is investing in artificial intelligence products for their database software. Imagine if your filing cabinet could analyze all your data automatically, find patterns, predict problems, and answer questions without you asking. That's what Oracle's AI-powered database does. These products require massive amounts of computing power to develop and train. Third, Oracle is forming strategic partnerships with other companies to pool resources and compete more effectively. When you're in a race you're losing, sometimes you team up with other runners. Oracle is trying to partner with companies that have strengths Oracle lacks. Each of these initiatives is expensive. Combined, they add up to needing $30 billion just to have a fighting chance in the artificial intelligence market for the next few years. Oracle's $30 billion raise is enormous, but here's what puts it in perspective. Every major tech company is spending at that scale or bigger. Microsoft spent around $10 billion annually on artificial intelligence infrastructure for the past 3 years, meaning they've committed $30 billion total just to catch up with the leaders. Amazon, through its cloud division, has been spending similar amounts. Google probably spends more than $30 billion per year on AI infrastructure, data centers, and chip research combined. Meta, the company behind Facebook and Instagram, has committed to spending $40 billion on artificial intelligence infrastructure alone. These numbers are staggering. Netflix spends about $3 billion a year on content, the most expensive streaming service in the world. Google's annual spend on AI infrastructure is roughly 15 times Netflix's entire budget every single year. Think about that. The amount of money one company is willing to spend on artificial intelligence in a single year is larger than the entire operating budget of most global entertainment companies. And Oracle is basically saying, we can't stay in this game without $30 billion more. The difference between Oracle and these other companies is that Oracle was playing catch-up. The others started building this infrastructure years ago. Oracle woke up late and realized they need to make up ground fast. That's why the market reacted so harshly. Oracle's stock crash and capital raise tell us something crucial about the future of technology and business. Artificial intelligence infrastructure is way more expensive than most companies budgeted for, and it's going to get more expensive. Think about what this means for regular people. The software and services you use every day will probably cost more. When Oracle needs to raise $30 billion to stay competitive, someone has to pay for it. Customers will pay through higher subscription fees. Shareholders will see lower profits as companies invest heavily in infrastructure instead of returning money to investors. Employees might face slower wage growth or hiring freezes as companies redirect resources. More importantly, Oracle's move signals that the companies making big promises about artificial intelligence might not fully understand what they are getting into financially. They're making commitments about artificial intelligence capabilities while simultaneously admitting they don't have enough money to actually build the infrastructure those capabilities require. For investors, this is a warning sign. When a stable, profitable company suddenly needs that much capital, it means competition is more intense than expected, and costs are higher than projected. For the tech industry itself, this is a reckoning. Companies are discovering that artificial intelligence isn't just about software, it's about owning massive amounts of computing hardware, and that's extremely capital-intensive. The companies that can afford to keep spending will dominate. The companies that can't will fall behind. If you're paying attention to technology companies or you have money invested in tech stocks, here's what you should be watching in the coming months. First, monitor profit margins. When Oracle raises $30 billion and starts spending it aggressively, their profit margins are going to shrink in the short term. Watch whether they can grow revenue fast enough to offset these massive new costs. If they can't, the stock will probably fall further. Second, watch debt levels. Oracle just added $30 billion to their debt. That means they're paying interest on that money. Interest payments reduce profits. Watch their quarterly earnings reports to see if the new infrastructure actually generates enough new revenue to justify the debt. Third, listen to what other tech companies say in their earnings calls over the next quarter. Will Microsoft, Google, Amazon, or Meta announce similar capital raises, or will they claim they've already invested enough? Their answers tell you whether Oracle's move is an outlier or the beginning of a larger trend. Fourth, watch for new product announcements. Is Oracle's new AI infrastructure actually working? Are customers excited about Oracle's new AI-powered database products? Product success is what will ultimately determine whether this $30 billion bet was smart or a mistake that takes years to recover from. Finally, watch stock prices in the sector. If other companies' stocks start falling too, it suggests investors are getting worried about the entire tech industry's spending spree. Here's what Oracle's 11% crash really means, stripped down to the absolute basics. Artificial intelligence is real, it's powerful, and it's going to change the world. But it's way more expensive to build than most companies actually prepared for. Oracle's $30 billion capital raise is an admission of that reality. The company is basically saying, we underestimated this, and we need to spend huge amounts of money right now to catch up. That's not necessarily a failure, it's a reality check. The tech industry promised us revolutionary artificial intelligence while underestimating what it would cost. Now that the real costs are becoming clear, companies are scrambling to raise money and adjust their strategies. Watch for more companies to announce similar capital raises. Watch for more growth announcements that emphasize investment over profit. Watch for subscription prices to increase, because companies need money to pay for all this infrastructure. And watch for the companies that can't afford to keep spending to fall further behind. The artificial intelligence race isn't just a competition about which company has the best AI products. It's fundamentally a competition about which companies can afford to keep spending the enormous amounts of capital required. Oracle's stock crash is telling you that this race is only getting started, and the costs are only going to climb from here.